I'm getting divorced after 60. What do I do with our retirement accounts? Splitting retirement accounts in a divorce after 60 isn't like splitting a checking account. One wrong form, one misstep, and you can hand the IRS a tax bill that didn't have to exist. By the end of this, you'll know the 3 different rules for 401ks, IRAs, and pensions in a divorce, and the one document that protects you from an avoidable tax hit. Here's the short answer. Retirement accounts can be divided in a divorce without triggering taxes or early withdrawal penalties, but only if it's done through the right legal mechanism for that account type. Use the wrong one, and the transfer gets treated as a regular distribution, taxable, sometimes penalized. So the first job isn't deciding who gets what, it's knowing which rulebook applies to which account. Point 1. 401ks, 403bs, and pensions need a QDRO. QDRO. That's a Qualified Domestic Relations Order, which basically means a court order separate from the divorce decree itself that tells the plan administrator how to split the account. Without a QDRO, the plan can't legally release the money to the ex-spouse. With one, the receiving spouse can roll their share into their own IRA tax-free. They also can take a cash distribution penalty-free under the QDRO. One of the few times you can pull from a 401k before 59.5 without the 10% penalty. Taxes still apply, but the penalty doesn't. QDROs are drafted separately from the divorce paperwork. They take time. Don't assume your divorce attorney is handling it. Ask. Point 2. IRAs don't use a QDRO. They use a transfer incident to divorce. Different rule, different paperwork. The divorce decree itself authorizes the split, and the IRA custodian moves the funds directly from one custodian's IRA to the other's. No taxes, no penalties, if it's labeled correctly as a transfer incident to divorce. If it's just withdrawn and handed over, that's a taxable distribution to the original owner. Big difference. Point 3. Pensions are their own animal. You'll need to decide between a lump sum buyout, if offered, or a share of the future monthly payments. Each has trade-offs around longevity, survivor benefits, and what happens if the pension-paying spouse dies first. This is where a lot of people leave money on the table, and where decisions made now lock in for life. Quick example to make this concrete. Say you're 62, getting divorced, and the marital retirement assets are a $600,000 401k and a $400,000 IRA. Hypothetical numbers, just for math. You and your spouse agree to split everything 50-50. 401k gets divided through a QDRO, the IRA gets divided through a transfer incident to divorce. Both halves land in each spouse's own retirement account, and nobody owes $1 in tax on the split itself. Now, imagine the same divorce, but somebody just withdraws $300,000 from the IRA and writes a check. That's a taxable distribution. At a 24% federal bracket, that's roughly $72,000 in federal tax on a transfer that should have cost nothing, plus state tax if applicable. Same divorce, same dollar split, wildly different outcomes. The paperwork is the strategy. One last thing worth knowing. A gray divorce doesn't just split accounts. It cascades into Social Security claiming strategies. Ex-spousal benefits have their own rules. Medicare enrollment if one spouse was on the other's employer plan. Beneficiary designations on every account, and life insurance policy, and your estate plan, which almost certainly names a soon-to-be ex. That's a lot of moving pieces, and they don't sit in separate boxes. A QDRO decision affects your tax bracket, which affects your Medicare premium, which affects your cash flow in retirement. This is exactly the kind of moment where having one team look at taxes, retirement income, Social Security, and the estate plan together instead of 3 separate professionals handling each slice actually saves you money and prevents the gaps where mistakes happen. If you're staring down a divorce after 60 and you want a second set of eyes on how all the pieces fit, that's what we do at Madison Partners. Links below.